Okay, foundations of real estate investing. So real estate investing can be many things. It could be the purchasing, it's the owning, it's the it can even be the managing or also the selling. There's different strategies involved, different property types. And I think when it comes to real estate investing, what you develop a bit of a niche in developing. And I think everyone should have a niche when it comes to real estate investing. Some people focus on purely long-term holding properties and renting them. Some are doing developments and renovations, and you'll find your fit if you're looking at real estate. And I think the market's constantly evolving, so there's loads of different ways to get exposure as well. So we'll be looking into both residential and commercial, evaluating some finance options, and also what to really look for when we're looking into the sort of due diligence and risk management perspective. So there's four real types of residences: single family homes, multi-family units, condominiums, and townhouses. And they might, depending where you are, be called different things, but this is really the categories that the finances are going to look at. And if we look at the pros and cons of it, you've got steady rental income, the potential for appreciation. And if we look at certain markets like the UK or the US housing market, which is mature, on average, you generally see 7% annual growth on the real estate appreciation. And then you have a broader pool of tenants as well. So in terms of vetting who's going to enter your property, you have a larger pick. The cons, and really the cons shouldn't be an impact on this side of things. Property management could be a chore, but there's many businesses that could outsource it and do manage it. I myself and my family, we use third-party property managers to manage all of our properties, and it really takes away that chore. So dealing with any sort of issues in the property that the tenant might have, they make sure that's all resolved. There's market fluctuations as we see right now, and we did see in the financial crisis of 07, the market is up and down. If you look at like the UAE market, which is done close to 2x in a 4-year period, or right now what's happening in the sort of the West, where you're getting on the brink of a collapse in the residential market. And it's all really depending on the lenders and the finance when it comes down to this. And I think it's careful evaluation and understanding your particular financing options when you're looking at these properties that you need to be paying attention to. Now, when you're looking at evaluating residential properties, there's four main things. One is location, and I think location is everything. On the residential side, depending on what kind of property that you're looking at acquiring and what your strategy is, that individual might want something. So if you're looking at a single family home, maybe it's a 1-bedroom apartment and it's close to travel and transport links into the city. That's what you're looking for in terms of if you're looking to rent for a small single individual. If you're looking for a family, you want to make sure that there's good school, it's in a good catchment area, that there's transportation links, and just I guess overall access is something that people are always looking for. So even road links that connect the property to major highways, that's something to really evaluate. Another is the property condition, and this really comes down to what your strategy is. If you're looking to take something at a major discount and you're wanting to do the renovation and you're going to flip it after, or you refurbish and rent it and refinance at a higher value, that's what you want to look at. And also understanding what kind of budget you've got there to make potential renovations and what the impact of those renovations. So certain things, and weirdly or not, you might think like adding a bathtub into a property increases the value, increasing the the sustainability factor of the property. So installing insulation, taking it from like a class E to a class A property. And certain markets, especially the UK market right now, there's loads of regulation in regards to the category that these properties sit in. Rental income potential as well. I think these are generally, if you've got a good location, there's an average. You're possibly looking at anywhere between sort of 6 to 8% ROI on your properties in terms of the rental. And then financing options, what's available to you as a personal individual and also against the property. Most financing is against the asset, and you'll come across different situations, and they'll all have their pros and cons, and we'll get more and more into that right now. On the commercial side, office buildings, retail spaces, industrial properties, warehouses, even storage units, that's considered a commercial real estate. And this is any real estate asset that it has a commercial use that's not a dwelling. So it's generating another revenue on top. And commercial units generally go for much higher returns, but that with higher returns comes a higher upfront cost. There's a lot more specialized knowledge. You need to understand the sort of the commercial lending markets and other industries. So if you've got a warehouse space in a specific type of, and it's an industrial unit, a specific type of industry, certain industry effects may impact that property. So it's always good to be aware. And this is where you'll start to develop niches for what you're looking at. And I think commercial real estate is a huge opportunity, and there's many recession-proof options as well, but with great returns comes great risk and just innovation as well. I think there's a lot you can do now in commercial real estate in terms of fractionalizing and the new business verticals that are opening up and new industries that are opening up. So multi-purpose space is a great one. So you're not limited to a specific industry. It's when you start to look at a cold storage unit where you're storing frozen products, for example, where whilst there might not be an issue with frozen products, but there may be an issue with that particular business that owns it. Maybe duties go up, the business starts to die if it's a distributor. So you're limited to one specific type of client, which is why when we looked at the residential real estate, you've got that larger pool of potential tenants. However, when you're dealing with commercial, you're dealing with businesses generally, and you've got professional relationships with those businesses, and you're guaranteeing most often not longer lease terms with the tenants. And yeah, the fact is when you're looking to evaluate, as I said, look, location is everything. If you had an industrial unit, you want to make sure that's close to logisticals like ports, or there's good trucking availability, the roads are good around for access, the lease agreements and the tenant stability. So what is the credit rating of that tenant? Because it's a corporation, you're able to assess it on a corporate level. How often do they pay their liabilities? You can see all of that and understand their trading history, how long they're going. And on a corporate level, you're allowed to ask those questions. They're a lot more diligent because the terms of their contracts are much longer. And once again, like whatever your financing options that are available to you. And I really think when we look into financing options on the infrastructure side, you guys will understand how dynamic you can be in utilizing different kinds of financial strategies here. Now, I would say four main calculations when looking at property, cash flow being the main one. Now, you might have heard of a balance sheet or an income statement, but a cash flow document essentially shows the amount of the cash that's coming in and the amount that's going out. So all of the inflows from sales of revenue, and then also the expenses. So all of those operating costs, your employee costs, your rent. So that will identify what the free cash flowing in your business is. Anytime, I like to call it the economy of the business. So it's a good way to understand what your working capital requirements are during your operation of this property and this asset. Another is cap rate. Cap rate's an interesting one. It's also known as the capitalization rate, and it's mainly used, I'd say, in commercial real estate to indicate the rate of return that's expected on the property, and it's good for comparing against other properties as well. So you're always looking at the current market value, and it's always based on a present time, and it doesn't take into account future appreciations. I'm sure many know what return of investment is. You're looking to see and understand evaluate what is the potential profitability of your investment. So on average, you're looking at, let's say, 5 to 8% ROI on real estate transactions. If you're developing it, this is going much higher up into the double digits. And that's where you really start to see a lot more profit on real estate. So one, real estate can be this nice, stable income, depending on your strategy. And another one, it can be an actual large cash generating asset, depending how you look at the strategy. That's your net income divided by the cost of the investment you put in times by 100 as a percentage. And a nice one that I like is this sort of the net operating income. And this is always at the bottom of the balance sheet. And this shows this measures the income producing profits, an income producing properties profitability before adding any sort of cost from financing. So any debt premiums, any taxes. It's also known as the EBIT. You might have heard of the EBITDA as well. These are corporate finance terms, but referring to a net operating income is more than enough. And once again, that's revenue minus net operating expenses. Strategies. Now, look, these are 4 main strategies if you want to get exposure into the market. I mentioned buy and hold. Buy and hold, you're looking for a property at a good value. You're eyeing it up for the long term. And you're looking for that rental income. So you're wanting the passive income from the rental and also some appreciation on that hard asset. As I said, the fix and flip is when you're looking to buy a property at a discount. So these could be at an auction. These could just be distressed assets that you've heard of that are on the market. They might not even be distressed. They may just be aged. A lot of what I've looked at is just older properties where you've had owners that have died in them. Essentially, they're just older owners and they haven't put the work in the later years of their life. So those are great opportunities because there's no real foundational issues and it's really a cosmetic job. So low investment needed into the refurbishment and huge returns. So whatever money you're putting in, you're buying it at a discount, you're investing into it, and you're looking to put money where there's going to add value. And then you can refinance based on that new value and you can compound this. So you've refinanced on that new value, you look for another asset, you put it back in, and you may have heard of this concept that came out the FIRE movement called BRR. So buy, renovate, rent, refinance. So that's a concept that's come out of this whole FIRE movement. And this, if you're really wanting to generate cash out of property, this is the only way. And I'll be realistic with you, this is the only way. And there's been a surge of people that have gone, like small-time developers that have started this, because the reality is you don't need a lot of income. You don't need a lot of your own equity to get exposure to doing these kinds of deals because you have good debt that you can utilize. So you've got and we'll get into this just on the next slide. Depending how you break down your tranches of debt, you can really minimize how much you expose yourself to that actual asset. And then another one, and look, I'm not going to confess to be an expert on this. This doesn't really exist in many markets other than the US, but essentially it's what they refer to as wholesaling. I don't really look at it as that. You're meeting someone who's looking to sell a property, you're agreeing that contract with that property, and then you're going to go source the investor for it. And more than likely, you're going to try and upsell that more than the asking price that you've already contractually agreed. And then you're going to pocket the difference. And that's what they call wholesaling. This market doesn't really exist in Europe. The US, it really took off. And I would say it's very oversaturated. And anyone who knows investing into property are going to know where there's a deal to be made. And you're not really going to be looking at large margins. So like this example here of $30,000, that's an unrealistic margin, I would say, for a wholesaler looking to do it. And essentially you're just a glorified broker escrowing cash in the middle. Risk management, risk management and what to understand. And we'll look at a case study as well when we go into this. You want to be looking at the property itself and what actually impacts that property. As I said, if you're looking at a distressed asset, are there any physical damages, foundational damages, damp, what kind of market fluctuations may impact it. And as I said, if you might pull up a floorboard and you might have cockroaches or a termite infestation. So that unexpected expenses that might be there that you never expected. Market risk. So we've got a huge one right now, like in terms of, financial risk with interest rates going up and banks terms being changed. And these kinds of things need to be evaluated when you enter a market, whether it's the right decision. And always, if you're making a deal, you want to know what your exit and stick to your strategy, just like when you're looking at other kinds of assets. Market risk, economic factors, such as now where we're looking at major market collapses in Europe, especially, and where they've had gross inflation for the last sort of 3-4 years on property values. And you get this sort of credit crunch. We've now got quantitative tightening. So there's interest rates are going up, less borrowing is occurring, the banks are doing less lending. So these sorts of situations actually create good opportunities where there are people that might be struggling with their properties to pay or refinance. So they might look for quick sales. So it's a huge opportunity to look at buying up people that have assets not in distress, but they themselves are in distress. So take advantage of the opportunities that present themselves. And due diligence is everything. And I would say that most mature real estate markets allow you to do due diligence. Here in the UAE, that you transact properties in the matter of days. It's like going out for shopping, which I wouldn't say is necessarily the best thing for the market. There are a lot of flaws, that unexpected costs and expenses that you probably couldn't account for. And but being able to have someone come in, assess the property's condition, as I said, the foundation, is there any damp that needs to be looked at? So any potential unexpected expense is expected. And these are the ones they know what to look for. And if you have a good auditor, they understand the area, they might know a bit of the history of the area as well. So what could have potentially have impacted it in the past. So they know from that basis how to evaluate the property. Financial analysis, and there's a lot of good sort of property websites out there now that look at the historical sales and the rental income of property. So being able to project what that property is going to do using the calculations presented before to understand and even compare, if you've got several deals that you're looking at, what is the best use of your capital? What is the best use of your capital with the least amount of risk? And contracts are everything. So you go through the contracts, get a lawyer involved. And this is why I would say in mature markets, property transactions take so long, because you get solicitors involved and they review the contracts, the lease agreement, they make sure everything's compliant. And there's good things about that and there's bad things about it. And a lot can happen in the 2 months or 3 months that a property is being transacted in, for example, the UK. Whereas here in the UAE, you're buying properties that you can do it at close in a day because everything's been standardized as much as possible. Financing options, most people really just rely on traditional mortgages. And I think they don't expose themselves to everything that's available for them. And they probably are not able to get onto the corporate ladder, not corporate ladder, the housing ladder, the housing market because of this. Traditional mortgages are obtained from strong institutional finance houses who have significant compliance. And you've got hard money loans. These are short-term loans, such as bridging loans. And this is something that I do quite a bit of, where you're lending money on a 12-month, and these are generally 6 to 12-month terms to finance renovation deals, and it's secured against the asset as well. So if they default, you claim the asset in regards. Private lenders, there's many individuals, you might know some around you. Brokers work with them. So if you've got mortgage brokers, there's several private lenders that will work with a broker. And this is why it's always good to evaluate the market and not just go to your local bank and ask for a mortgage just because you perceive that they've all got standard rates, because there are pros and cons of each one. Crowdfunding is another one. If you want to limit your exposure, you could crowdfund amongst friends. So if you had a deal and you needed to raise the equity for that deal, you could talk to a few friends, and maybe you only need to put like £30,000 down. You could pull that together between 5 people and you make the difference. And as I said, like pros and cons, traditional mortgages will allow for lower interest rates. The commercial banks are buying directly from the central bank rates, so they're just adding premium onto that. So they're much higher up the food chain. These terms can vary much longer as well, as opposed to the hard cash ones we'll look at in a bit. But you can get mortgages anywhere from 3 to even 15 years in some circumstances, and depending on the property type. And it's a form of structured debt that's built into the asset and secured against the asset as well. So as long as that property is generating revenue and it suffices enough to cover that mortgage payment, the property is profitable. But as I said, stricter qualification criteria. And if you have had poor credit, you've had a credit card that you've maybe missed a few payments on, you've fallen off the credit rating score, then you might be approved a mortgage, but it might come at a higher interest rate, or they might not just approve you at all. And there's even circumstances here where the banks may ask you to go to a doctor to have a full health checkup to make sure that you are fit and healthy to pay back this mortgage. So there are things like that. And as you get older as well, getting a traditional mortgage does become a risk on the bank, and they are less likely to look at you. Hard money loans, and whilst called hard money loans, we look at them as bridging loans, because when you're taking out a traditional mortgage, you don't actually see any of that money. It goes directly to the person that you're buying the property from. These are bridging loans to support generally renovation projects. There's no real emphasis on credit scores like traditional finance, because you're securing it against the asset. Much quicker to get approval and getting the cash in your hand to pay out any sort of cost that you've got on renovation and construction. But because it's shorter, you're getting higher interest rates. These are, whilst there are some sort of reputable institutions that offer them, there are more private lenders in this market. The interest rates are a lot higher and they may be less forgiving, but there are other ways to make them forgiving. And we'll just look into that now when we look into sort of private lenders and partnerships. And these are the people that you're really going to interact with through mortgage brokers and lending brokers, because they're going to have the connection, and then you're in an ability to develop a relationship with that person. And if you've got a few deals and you're looking to build something up, you can build this up over time and get like a supply chain agreement with them, or a supply finance agreement where you find the assets and they'll lend, or they might even put the equity up. So there's some great opportunity here when talking to lenders. And these guys have much looser criteria, but it comes with a higher interest rate. Crowdfunding, like this is something that's just really come around in the recent few years, but I would say that it's always existed. And as I gave an example before, that if you were looking to get onto the real estate market, you don't necessarily have your own money, just identifying a deal where there's enough there for you to top slice off it and bring exposure from friends, and you present the deal in a pitch, show the value of it, show what it's going to do, the performance, the projections. And so there's loads of ways that you can get exposure to real estate without actually having to put capital in. And that's really the case with most assets. It's what I refer to as, and what the market refers to as, sweat equity. Just a small case study of what you would look at if you were evaluating a residential property. And you do this on a case-by-case basis. And it's a good way, especially just to document your thoughts and evaluate the asset. So we've got this property ABC. It's located in City X. It's a multi-family residential property. That means it's got 10 units in that apartment complex. Your investment strategy, which is a buy and hold strategy for 5 years from 2018 to 2023. It's a long-term investment where you're looking for some small potential appreciation, but more for the rental income. Now, City X, it's a growing city. They might have a Starbucks opening up. It's another good sign. Strong job market, possibly a growing job market, new industries coming in. Anything where you're seeing this increase in population, especially in these areas that are getting gentrified, these are good opportunities. if there's big industrial players that are around that could offer these jobs, that's another good opportunity for the city as well. So City X seems to match all of these boxes. And then you're assessing the property, and the property or ABC Apartments was a discount. It needed some renovations and upgrades. So you assess what those are, you make the upgrades to it, and straight away, as soon as you've made those upgrades, the value of that property is increased, and you can refinance against it and release that equity, is what we refer to as an equity release, and start to increase your holdings and diversify that portfolio with the capital. That property, apartment ABC, has benefited from a 2018 to 2023 with great appreciation. It's generated revenue and rental. And then you evaluate what's it done in that term as well, to understand that, yeah, this was a good investment. And I think just relying on this and creating a template for this when you guys are evaluating properties is something that should be done for not just a single case by case basis.